All right, let's dive right in. In this session, we're going under the hood of a professional analyst's case study on the energy giant Chevron. We're going to walk through the exact step-by-step process an expert uses, looking at cold, hard data through a disciplined, unemotional lens to get to a clear investment decision.
You know, every professional analysis really boils down to one central question. And for us, it's this. Based on the data as of January 2026, is Chevron a stock you should buy? Is it the right company at the right time? And this is the most important part. Is it at the right price? Let's find out.
And let's not bury the lead here. The answer, based on this rigorous analysis, is a crystal clear no. The stock simply does not meet the minimum requirements for an investment right now. But honestly, the verdict itself isn't the most important part of this. The real lesson is in understanding why it fails the test. That's where the value is.
So here's our game plan. First, we're going to look at the simple qualification test that Chevron failed right out of the gate. Then, we'll dig into the absolute core of the problem, a really dangerous situation that analysts call a perverse inversion. After that, we'll look for other red flags that confirm our thesis, lay out a conditional strategy for when this stock could become a buy, and wrap it all up with the final, most critical lesson.
Look, professional analysis has nothing to do with gut feelings or hunches. It's all about a disciplined, repeatable process. And that process starts with a simple, totally non-negotiable qualification test. Think of it like a bouncer at a club. If a stock can't get past this first checklist, the analysis stops. It's a non-starter.
And as you can see for yourself, the result is not good. On the first point, the CVX rank, which is basically a rating based on what analysts expect for earnings, it gets a no. A number 3 hold just doesn't cut it. We need to see a buy. And then there's the third criterion, which is maybe the most telling, insider buying. It's another hard no. The executives themselves are selling, not buying. Sure, it passes on trading volume, but who cares? 2 out of 3 fails means it's disqualified. Game over.
But you have to ask yourself, why did it fail that test? Well, it's not random. It's because of a fundamental, dangerous disconnect between how the company is actually doing and what its stock price is. This is the real heart of the problem, what the pros call a perverse inversion. And trust me, it's as bad as it sounds.
Okay, first, just look at the fundamentals. From the end of 2023 through the estimates for late 2025, Chevron's actual profits, its earnings per share, are projected to fall off a cliff, down 43%. And let me be clear, this isn't some tiny dip, it's a major decay in the company's ability to make money.
Now you'd think if profits are tanking, the stock would get cheaper, right? Wrong. In fact, the absolute opposite happened. During that same period, the stock's valuation, its price tag basically, went up by 75%. So the market is asking investors to pay way more for way less profit. It makes no sense. And this is that dangerous combination. The business fundamentals are getting worse, but the price you have to pay is getting much, much higher. That is the perverse inversion. It's a classic, textbook warning sign that a stock is totally disconnected from reality. And historically, that kind of disconnect doesn't end well. It often comes before a big price drop.
Now look at how crazy this has gotten. This inversion has created a massive premium on the stock price that just seems unsustainable. Right now, investors are paying a PE multiple of over 22 for Chevron. Its direct competitors? They're trading for just over 10. You're literally paying more than double for Chevron's shrinking profits compared to everyone else in the industry.
Okay, so that perverse inversion is a huge piece of evidence. But a good analyst, just like a good detective, never relies on a single clue. You've got to find other pieces of evidence that tell the same story. You need to corroborate the red flags.
And one of the most powerful places to look for clues is what we call insider conviction. It's a simple question. Are the people who know the company best, the top executives, the directors, are they buying the stock with their own cash?
And the answer here is not just no, it's a heck no. In fact, it's the total opposite. Insiders have sold more than $143 million of their own company's stock, and the amount they've bought? Zero. Zilch. Nada. When the people with the most information are cashing out, you have to pay attention. That is a major, major red flag.
And you know what? The warning signs just keep piling up. We already know the CVX rank is a lukewarm hold. On top of that, Wall Street analysts keep lowering their expectations for the company. And to cap it all off, the entire energy sector is pretty out of favor right now, ranking near the bottom of all industries. See how the evidence is starting to compound? The case against buying just gets stronger and stronger.
So does all this mean we should just write off Chevron forever? No, not at all. A disciplined analyst doesn't just say no and walk away. They say, not right now, but here's what would need to happen for me to change my mind. And this is what turns a simple verdict into a real actionable strategy you can use.
The plan is simple and clear. There are 3 conditions. First, that Zacks rank needs to flip from hold to buy. We need to see the experts get bullish. Second, the insiders have to start buying stock again, showing us they've got real conviction. And third, and this is a big one, the price has to come down to a more reasonable level to get rid of that crazy inversion. Until all 3 of those boxes are checked, the disciplined investor does nothing. You just wait.
So let's just zoom out from Chevron for a minute, because this entire case study isn't really about just one company. It's about a timeless, absolutely critical principle of successful investing. This is the ultimate lesson we need to take away from all this.
And here it is. A great company is not always a great investment. Let me say that again. A great company is not always a great investment. Chevron is an incredible, globally important company. Nobody's arguing that. But a great company can be a terrible investment if you overpay for it. At its current price, the risk is just too high and the potential reward is too low. Remember, the price you pay is the #1 thing that's going to determine your future returns.
So I'll leave you with this final question. It's the one you should ask yourself every single time. It's easy to find and fall in love with a great company, but the disciplined investor always asks the harder question. Am I just buying a great company, or am I buying a great stock at the right price? Because that distinction, that is everything.